7.3 Risk. The fallacy of setting price targets or single point estimates of intrinsic value. I believe you should always think about investments in terms of probabilities, that is, possible ranges of values with probabilities assigned to each value. Michael Marbusson, Legg Mason. Risk is an interesting psychological phenomenon. Some people love risk, others hate it. Some people love taking crazy risks when they are young and then seek to avoid taking most risks when they are old. Some people take risks after carefully considering them. Others take risks without much consideration, or sometimes without even being aware of the risks they are taking. This section looks at what risk is and how we can possibly measure it. Also see the great video, Risk Analysis. Muddy swamps. There is a high, hard ground where practitioners can make effective use of research-based theory and technique. And there is a swampy lowland where situations are confusing messes, incapable of technical solution. In the swamp are the problems of greatest human concern. Donald Schoen. In business, risks are lurking everywhere. But what is risk? Risk is uncertainty, not knowing what might happen next, not knowing what might happen in the future. In a sense, risk is not being able to know. Risk can also be thought of as a probability distribution, different expected probabilities or likelihoods of different possible outcomes. We live in a world where the unexpected can happen, and it probably will. Things we do not expect to happen might happen, and they might happen when we do not expect it. It is easy to think of risk as being the possibility of bad things happening, things we do not like or which are painful. However, risk is more like uncertainty about whether good or bad things might happen. Investing in the equity of firms is about balancing risk and return and seeking that balance in our favour. It is a bit like the owners of gaming machines in hotels. If we can get the balance between risk and return in our favour, we should find plenty of money when we open the back of the gaming machines. To be able to use our discounted cash flow and economic profit models, we need to forecast returns to equity investors, which is the expected future abnormal operating income or expected future cash flows. When we are dealing with the future, we can only talk about expected returns. This means we must also acknowledge the possibility of the unexpected, the possibility, or indeed perhaps the near certainty, we might receive returns that are different to those we expect. As I mentioned in the previous section, a difference between firms and gaming machines is that, unlike gaming machines, firms are not machines that can be set in certain ways. Indeed, there are many things we cannot control in business, including the environment of firms. The reality is that business and life is uncertain. We do not know the future, and the future will be full of surprises and of the unexpected. Risk is the recognition that we might in fact receive something different from our expected future returns. It may be better, it may be worse. A key factor in determining the required rate of return for investors is an assessment of the risk of a business compared to the risk of alternative investment opportunities that might be available to investors. This will determine a firm's cost of capital. This section looks at how we can assess the risk of a business and how this can help us to assess the cost of capital for a firm. You may have studied finance theory. Much of modern finance theory is based on the notion that listed share markets are efficient, and the share prices of listed companies effectively always reflect the intrinsic value of firms, often expressed as reflecting all publicly available information. The required rate of return for equity is seen as comprising a risk-free return, which can be related to the long-term return on government securities, and a premium for risk. The variability of returns of a portfolio of investments in listed companies can be reduced by adding the shares of more listed companies to that portfolio. The aspect of variability of returns from a single firm that impacts on the variability of returns of a diversified portfolio of investor is the non-diversifiable risk, or the systematic risk of a firm. This is the risk finance theory suggests a firm contributes to its equity investors and for which they need to be compensated in terms of the level of expected returns. In finance theory, asset pricing models are designed to calculate a required return for an equity investment in a firm. They do this by calculating the risk premium for an equity investment based on its sensitivity to the systematic risk of a fully diversified market portfolio, called its beta. No one can calculate a firm's beta precisely. I'll say that again. No one can calculate a firm's beta precisely. The calculation of a firm's beta is based on looking at the past variability of a firm's listed share price relative to the share market overall, and assuming this relationship will continue in the future. This beta of a firm is then multiplied by the market risk premium to calculate the risk premium for an equity investment in a firm. This is then added to the risk-free return to calculate the equity cost of capital for a firm. The key point to note is that a firm's beta does not directly connect us to the actual business risks of a firm. It also takes no notice of any deviation of a firm's share price from its intrinsic value. The risk of an equity investment is simply based on the past variability of a firm's share price relative to the share market. See the great video, Risk Finance Theory, to review how we use beta in finance theory to measure risk. Quite a few equity investors would say, who cares about a firm's beta? Even if it were possible to measure it convincingly, which is somewhat questionable, we should ask ourselves how a firm's beta would affect my view of the risk surrounding my equity investment in a firm. For example, suppose I arrived at a valuation for Ryman Healthcare of about $16 per share. If I was able to purchase shares in Ryman Healthcare at $12, I would have a significant margin of safety and a degree of protection if my forecasts of Ryman Healthcare's abnormal operating income or cash flows that underpin my $16 per share valuation proved to be optimistic. Alternatively, suppose I purchase shares in Ryman Healthcare at $15.95 per share. I would have a small margin of safety and little protection if my forecasts of Ryman Healthcare's abnormal operating income or cash flows proved to be optimistic. Although the calculated betas of Ryman Healthcare might be identical in both cases, the risks of my equity investment in each case would be very different. Further, the approach to measuring the risk of investing in a firm based on its beta relies on other people's judgments, namely on the movements of past listed share prices of a firm relative to movements in the share market. Listed share prices are simply the views of the marginal investor about the value of a firm's equity. A key tenet of financial statement analysis, and more generally of fundamental analysis, is that we base our assessments of firms on our own analysis of a firm's value. In the words of Michael Polanyi at the beginning of this chapter, so it is our personal participation that governs the richness of concrete experience. We ourselves need to know what adds value. We never hand this task over to someone else. Clearly, an assessment of the risks of investing in a firm is a key element of financial statement analysis and of fundamental analysis of firms. The risks of investing in a firm cannot be understood without us understanding the risks of a firm's business. We must engage in this swampy lowland and admit the risks of a firm's business are incapable of a tidy, simple, technical solution. Analysing risk. The equity cost of capital is driven by the risks of a firm's business activities relative to the risks of alternative investment opportunities. A consideration of risk is essentially a consideration of alternatives, of alternative future outcomes. It recognises that the world is not certain, that business is not a world of point estimates of certain outcomes. It also recognises that risk is not the result of share markets, nor of changing numbers in the financial statements of firms. It is the result of the business activities of a firm, the way a firm conducts its activities in an environment of uncertainty. Our economic profit model leads us to value the equity of a firm as follows. The value of equity equals the book value of equity plus abnormal operating income in year 1 divided by WACC plus abnormal operating income year 2 divided by WACC squared plus ... plus abnormal operating income in year t divided by WACC to the power of t plus the continuing value in year t divided by WACC to the power of t. We discount the expected future abnormal operating income of a firm to reflect the time value of money. Returns in the future are worth less to us than returns today, including the risk or uncertainty that the firm will indeed generate the expected future abnormal operating income. Indeed, it will almost certainly to some extent do something else. This is incorporated in the discount rate, the required rate of return for the firm or its weighted average cost of capital. In this way, our economic profit model includes risk as well as the expected earnings of a firm. The same applies to our discounted cash flow model. Analysing and forecasting risk for a firm is the same process as analysing and forecasting the earnings of a firm. Analysis is breaking things into bits. Including risk in our analysis is simply thinking about our analysis in terms of the potential for several possible outcomes rather than simply a point estimate. Just as accounting drivers determine abnormal operating income or cash flows, so the risk or uncertainty with each of these accounting drivers determines the business risk the firm faces. Analysing risk involves carefully examining each of the accounting drivers of abnormal operating income or cash flows and linking these to the key economic and business drivers of the business. We need to understand the risks the firm faces with each of its key economic and business drivers and the uncertainty inherent in the forecasts of these key economic and business drivers. Let us consider how this might work with Ryman Healthcare. In Chapter 4, Section 4.4, we identified the following key economic and business drivers of Ryman Healthcare's profit margins and of its return on equity. Strong development margins and growth in residential property values. Strong demand for retirement village units. This is due to about 3% per year population growth in the 75 plus age group in New Zealand and Australia, a growing proportion of people in the 75 plus age group in New Zealand and Australia who wish to live in retirement villages. Ryman Healthcare's significant capacity to develop, own and manage retirement villages, rate of turnover of occupation rights to Ryman Healthcare's existing retirement village units of about 7 years, high occupancy levels of Ryman Healthcare's retirement village units, serviced apartments, rest homes and hospitals. In Chapter 5, we forecast some of these key economic and business drivers. We forecast reduced levels of expected future growth in residential property values, continued strong sales growth, Maintenance of Ryman Healthcare's significant capacity to develop, own and manage retirement village units. Maintenance of the existing rate of turnover of occupation rights to existing retirement village units of about 7 years, and continued high occupancy levels. We develop point estimates of forecast growth in residential property values and in revaluations of Ryman Healthcare's properties for the next 5 years. See tables 7.1 below. We also came up with point estimates of forecast growth rates for each source of Ryman Healthcare's sales for the next 5 years. See table 7.2 below. One thing certain about these forecasts is that they will be proved wrong by the unfolding of actual events. There will be surprises. For example, growth in residential property values may prove to be lower in 2022 and 2023 than I forecast. That is, we might see a smaller rise in residential property values in these years rather than the high growth rates I have forecast. For example, because of the Reserve Bank in Australia and New Zealand raising interest rates and reducing quantitative easing, that is, reducing the amount of printing money. Also, growth in residential property values forecast in 2024, 0%, 2025, 2.5%, and 2026, 5%, might prove to be overly pessimistic should the economic upturn after the pandemic prove stronger than I expect. I've also forecast the sales of new occupation rights in volume terms to remain constant at 750 units each year, although the value of these sales is forecast to increase in line with my forecast of residential property values. Ryman Healthcare might be able to exceed these forecasts, or alternatively it may face some problems with its construction of new properties at some time in the future, which might result in it achieving a lower level of construction in some years. In this way, we could review all my forecasts for the key economic and business drivers of Ryman Healthcare. Instead of viewing them as point estimates, I can start to see them as distributions of a range of possible futures. I might see Ryman Healthcare as possibly having more potential to exceed my forecasts of sales of new occupation rights than to fall short of reaching them. I could further examine their property development plans, their land bank of development sites, and carefully track their announcements over time about their purchases of future development sites and the progress of their developments. Behind this approach is a way of seeing the world that acknowledges the future as being uncertain. I can include in my analysis a sense of the type of distribution of potential outcomes I might envisage around my point estimates. Also, I can run a range of sensitivities of my forecasts to measure the impact on my value of Ryman Healthcare of changes in some of the key economic and business drivers. By linking them to a change in Ryman Healthcare's accounting drivers and to its accounting-based measures of value. This is one of the great things about spreadsheets. Using my spreadsheet, I can incorporate the good thinking and ideas set out in this study guide to bring together my analysis, views and opinions about Ryman Healthcare into a dollar value for the firm. Over time, I can increasingly include my own thinking and ideas into my spreadsheet for Ryman Healthcare, increasingly making it my own spreadsheet, making it my own tool. I can run as many different sensitivities as I like until I have a very good feel for the impact of my various key judgments in my forecasts on my value of Ryman Healthcare. In this way, I can begin to see the value of Ryman Healthcare as a range of values based on different views about the future for my firm, and so gain an understanding about the risks I might be taking with an equity investment in Ryman Healthcare. This section has looked at what risk is and how we can measure it. We considered the high, hard ground of techniques based on finance theory and the swampy lowland of looking at a firm's business risks as confusing messes incapable of simple technical solutions. In the next section, we will look at the benefits of ensuring a substantial margin of safety before we make equity investments in firms. 7.4. Margin of safety. A margin of safety is a rational, intelligent response to the reality of risk. See the great video, Margin of Safety. Firms are not gaming machines. They cannot be programmed. They will never be fully predictable. Indeed, there is only one thing certain about the forecasts of Ryman Healthcare discussed in the previous section, and that is that they will prove to be wrong. These forecasts are almost certainly a view of a future reality that will never exist exactly as forecast. Also, only a few key aspects of the potential future realities for Ryman Healthcare are being forecast. The future reality of Ryman Healthcare will include a range of other details and aspects not part of our forecasts. Real business, real life is always complex, messy, and difficult to put convincingly into any technical box. A range of futures. One thing we can do is to change some of these forecasts and see what effect this would have on our forecasts of Ryman Healthcare's abnormal operating income and on its value. We can create a range of futures for Ryman Healthcare. These sensitivity analyses can help us focus on those aspects of our forecasts that contribute the most risk or uncertainty to our estimate of the value of Ryman Healthcare. This can help us to focus more effort on analysing these aspects of the business and seek to gain greater comfort with our forecasts for those items. In the terminology of statistics, this involves us thinking about dispersion as well as central tendency. Dispersion is the spread, the variety, how far the future realities of a business might diverge from our dream or view of its future. Central tendency is the point estimate, or where our dream or view of a firm's future is centred. Gaining a feel for a firm's business risks involves gaining a feel for the dispersion of the potential outcomes for a firm, as well as at what level we think this range of potential outcomes might be centred. This involves our minds following several different paths or routes for the firm going forward. Within the framework of our perception of the firm's strategy, unless we find ourselves considering several different potential outcomes for key aspects of a firm's operating or business activities, then we are not engaging ourselves with a firm's risks. As we begin to understand that the discounted cash flow and economic profit frameworks each provide us not with one, but with a range of potential values of a firm, we begin to understand the risk any equity investment in a firm presents to us. Once we recognise the existence of risk in business, how do we make risk or uncertainty our friend rather than our enemy? The best safeguard to help make risk our friend rather than foe is a margin of safety. A margin of safety is the difference between our best estimate of the value of a firm and the amount we pay to purchase an equity interest in a firm, that is, its market price. If we value Ryman Healthcare at $16 per share and its listed share price was $12, we will have a larger margin of safety than if its share price was $15.95. Another way of putting it is that if we value Ryman Healthcare at $16 and purchase shares in Ryman Healthcare at $15.95, this is a much riskier investment than if we purchased the shares at $12. A large margin of safety is our best safeguard or response to the business risks of a firm. Understanding the risks of a business is a key part of understanding a firm's business. To understand a firm's risk, we need to understand the economic and business drivers of a firm and to generate several scenarios rather than just one or the expected scenario. In other words, we need to dream several different dreams for a firm, not just one. We need to reflect on several different futures for a firm, none of which may be likely to happen exactly as we might see them. But these dreams will be what will drive our view of the value of a firm. In our competitive capital markets, it will be a battle of dreams for a firm, a battle of who is better able to dream dreams of a firm's future and skillfully connect these dreams to a value for a firm. Capital markets are a collective process and interaction between many people, a community of dream making. It is a firm's actual future actions, led by management, that will show whose dreams formed in the equity capital markets were closest to the mark, worked out in the messy swamp of a firm's economic and business realities as they emerge into the light of the moment. This will involve understanding how a firm is managing the key risks it faces. You could calculate abnormal operating income for several scenarios based on forecasts for each scenario. Indeed, the running of sensitivity analyses is a key method to appreciate and identify the key risks incorporated into our value of the equity of a firm. Spurious accuracy. We hear over and over from corporate managers that the market cares only about the next quarter's earnings. When valuing companies, investors are said to do little more than apply a relative PE multiple to trailing or next year's projected earnings per share. My experience is that most successful investors, as opposed to traders, do not rely on simplistic multiples or short-term earnings in making these investment decisions. But they also spend little time worrying about getting the cost of capital exactly right, or working with a sophisticated asset pricing model. Trevor Harris, Morgan Stanley. Despite the lure of precise measures of the cost of capital that are produced by various services using versions of asset pricing models, we need to be careful. The present state of knowledge about how to measure risk and estimate costs of capital cannot provide a reliably precise measure of the cost of capital. In terms of future developments in our thinking about financial statement analysis, getting better at quantifying risk and our measures of cost of capital would be valuable and is an area where the growth of our knowledge needs to develop. Indeed, knowledge can be produced wherever serious problems are being attacked and followed to their root. However, it remains in the future when our thinking, hopefully, will substantially improve in this area. The way we need to handle risk in our analysis today is to treat it in the same way as we treat a firm's earnings. We need to understand the accounting drivers of risk for a firm in the past and the economic and business drivers that have been driving those risks. We then need to forecast these economic and business drivers under several scenarios and convert them into forecasts of the accounting drivers under each scenario, and then into a range of values for a firm. The relation of this range of potential values for a firm to the current share price of a firm, or of a price we may offer or be offered for shares in a private company, will help us to assess whether the safety margin between our estimate of value of a firm and the current share price is sufficient. It is also vital to run sensitivities of any value for a firm for a range of discount rates or costs of capital. Risk is essentially a qualitative factor that we need to include in our discounted cash flow and economic profit models in a quantitative form. Sensitivity analysis, informed by our qualitative assessments of various accounting drivers and the costs of capital, is essential to properly understand the risks an equity investor would be assuming by acquiring equity in a firm. We need to calculate a discount rate, or ROF, to be able to apply our discounted cash flow and economic profit frameworks to the analysis and valuation of a firm. In the imagery of Donald shown, see his quote in section 7.3 above, we need to move from the swampy lowland where the problems of greatest human concern occur and move to the hard ground where practitioners can make effective use of research-based theory and technique. But we need to tread warily and not deceive ourselves that there exists the possibility of technical rigour where there is none. And when it comes to calculating costs of capital, we must forsake technical rigour in estimating costs of capital and, well, guess. The trick is to guess as intelligently as we can. We saw in Chapter 6 that we can simplify our analysis of a firm by focusing on the enterprise or operations of a firm. We can safely do this if we think that a firm's financial activities are not materially adding value to a firm. In the swampy lowland of assessing a firm's risk, focusing on the operations of a firm rather than on its equity has a significant benefit. We have seen that a firm's equity cost of capital will change as a firm's financial leverage, FLEV, changes. If you look at most firms, their financial leverage changes over time. For example, Table 7.3 sets out how Ryman Healthcare's financial leverage has changed over the past few years. Table 7.3, Ryman Healthcare's financial leverage. It's basically increased from 0.31 in 2014 to 0.78 in 2021. The increase in Ryman Healthcare's financial leverage from 0.31 in 2014 to 0.78 in 2021, that is about a 150% increase, would have exerted an upward influence on Ryman Healthcare's equity cost of capital during this period. It is likely Ryman Healthcare's financial leverage will change further in the future. What this means is that even if we felt we were able to calculate Ryman Healthcare's equity cost of capital, ROE, with a degree of confidence, we'd have to keep changing our view of its future ROE in line with our forecast of its financial leverage. This is a significant complication to how we apply the discounted cash flow and economic profit frameworks to the analysis and valuation of firms. However, if we instead focus on the operations of a firm, we do not need to change our view of the firm's cost of capital for operations, ROF, with changes in a firm's financial leverage. This is because a firm's cost of capital for operations, ROF, is unaffected by changes in financial leverage. As we face the challenges to incorporate risk into our discounted cash flow and economic profit frameworks, it is good to remove this complication by focusing on a firm's operations. In this section, we have seen that a margin of safety is a key concept for managing risks with our investments. A margin of safety is the difference between our best estimate of the value of a firm and the amount we pay to purchase an equity interest in a firm. That is its market price. We have also seen that focusing on valuing a firm's operations can simplify our assessment of risk in our valuations, as we do not need to adjust our forecasts for changes in financial leverage. Conclusions. In this chapter, we've discussed the issues of how to predict the future of a firm for eternity. We've acknowledged the impossibility of this task, and that this underpins the subjective nature of financial statement analysis and the valuation of firms. To incorporate our judgments or guesses about a firm's future beyond the visible horizon of what can be reasonably estimated or predicted, we need to calculate a continuing value. We also looked at the formulas for continuing value we have incorporated into our spreadsheets in this unit. These continuing values are perpetuity-based formulas with constant growth rates, margins, asset turnover, and weighted average cost of capital. They also make explicit assumptions about return on incremental net operating assets, the expected rate of return on incremental net operating assets, that is on new invested capital, that is invested after the forecast period. Another difficult issue in the use of the DCF, discounted cash flow, and economic profit frameworks is how to best incorporate risk. We saw the importance of thinking about several scenarios for the future of a firm rather than just one. In statistical terms, this means not just focusing on central tendency, that is our expected future abnormal operating income or economic profit, but also on dispersion, that is how widely different or spread do we expect a range of possible future abnormal operating income of a firm might be. We also saw the central importance of having a substantial margin of safety to manage risks as we seek to move the risk-return relationships of our equity investments into our favour. We are now coming near to the end of our discussion of what it might take to analyse a firm's financial statements to help us to know what adds value to a firm. In the next and final chapter, we will discuss how we might be able to take with us into our lives and careers the ideas and knowledge we have discussed in this study guide. In other words, we'll think about how the good thinking and ideas of accounting and finance might cause us to change the way we view business reality, how we see, think about, and make personal sense of aspects of business.